So fundamental equity research does not work when you're looking at the tech sector. And the reason it doesn't work is because technology moves too fast. It's difficult to judge where you are in the cycle, and valuations tend to be permanently high. So at first, some of these traits were specific to the technology sector, but in recent years, they've been increasingly applicable to media and telecom sectors too, as disruptive technologies spill over into these sectors. As a result, traditional bottom-up valuation methodologies have had a poor track record of predicting share prices in tech, media and telecoms, so we've developed an entirely new approach to looking at the tech sector, and this is how it works. So the first thing we do is we split the global TMT sector into 18 subsectors. Everything from social media to telecom operators to e-commerce to film production. And then companies within each subsector peer group will be impacted by similar investment themes at similar timescales, and they'll trade at similar valuations. An investment theme like mobile payments, for example, may impact some sectors, but not others. Our thematic approach first started with just technology companies. We then expanded it to cover media and telecom companies as well, as they became more technology-based. And in future, it's likely that more and more industries will fall into our remit as they too become technology-based. And three industries that immediately spring to mind are defense and aerospace, automotive components, and healthcare. So once we've identified our 18 subsectors where all different themes have a different impact, then we apply a three-screen approach to value the companies within each subsector. The first screen is a valuation screen. The valuation screen ranks stocks by how expensive they are relative to their peers, using the metrics appropriate to that specific sector. Second screen is our thematic screen, and our thematic screen tells us who the technology leaders and laggards are in the technology cycles that are most important for that specific sector. And finally, we have a risk screen, which ranks stocks within a sector by the level of investor risk as we see it. We split it into four areas: governance risk, accounting risk, political risk, and technology risk. And then finally, we consolidate the scores on these three screens to produce an overall ranking for the top 500 global TMT stocks. Now, valuation screens and risk screens are nothing new to you guys, but what's unique about our approach is our thematic screen. So let's see how that works. So the first step in our thematic screen is to identify the big themes that are going to impact these 500 global TMT stocks. Now here are some of the big tech themes globally. It's going to come up on your screen in a second. They're all interconnected. In mobile, for example, we have operating systems, maps, payments, and games. In social media, we have messaging, crowdfunding, virtual currencies, the sharing economy. Under advanced manufacturing, there's 3D printing, robotics, driverless cars, artificial intelligence. And then we have other themes like internet TV, wearable technology, big data, the Internet of Things, software-defined networks. Now, identifying the right themes for the right sectors is pretty tricky. There's 100 tech themes out there right now. How do you know which ones are the most important? Sometimes a theme can be too far away to have an impact now. Mobile payments, for example. Every analyst has been saying mobile payments is going to take off this year for the last 10 years. It hasn't really taken off yet. By contrast, software-defined networks, that's a technology that doesn't really exist at the moment, but it's moving stock prices like Cisco and Juniper already, and it doesn't even exist. So once we've identified the themes, step 2 is to drill down into a specific theme. I'll take big data as the example, and identify the most important technologies that are going to drive this theme. So take big data as an example. We started looking at big data in 2011, and we updated our thinking as things changed. Now, big data is a theme that impacts not just the tech sector, but also media, healthcare, retail, manufacturing, aerospace, and many other sectors. So this is what the value chain looks like for all of those sectors. We generate big data from our digital activity. We leave digital footprints when we browse the web, send an email, or look at a document online. So we, in essence, are the product. In the middle bit of of this value chain is how we manage data. And there's 7 technologies, there's a stack of 7 technologies that are the key technologies for managing this data. Analytics, database, IT integration, network, security, and storage. This middle bit is where the value is where the bottlenecks are. And then finally, big data is consumed by end users, like advertisers, search engines, and all kinds of business intelligence users. And we concluded when we looked at this a year ago that the 2 big bottlenecks worth investing in the big data value chain were analytics and security. The rest of the value chain contains relatively easy technological problems to solve, and as a result will face increasing commoditization and downward pricing pressure. So once we've identified the areas to be in, how do we pick the winners within those technologies? So step 3 is to identify the market leaders and challengers for each critical technology. Now we've already identified analytics and security as critical technologies, so let's drill down a little bit further. Let's pick on the security stack and drill it into its component parts. Say threat management, network security, email gateways, user authentication, and so on. And we concluded a year ago that the real bottleneck in the security market then was unified threat management. What does that mean? Well, if products like Symantec's Norton Antivirus, they're great at detecting threats we already know about. But the real risk today in security is called zero-day attacks, or threats we don't know about. And for that, you need artificial intelligence software to capture those threats. And we think stocks like FireEye, Checkpoint, Palo Alto, and Fortinet lead in that field. So we narrowed down our stocks using the technology that we thought was most critical. And then finally, having identified the technology leaders in each critical technology, we put it all together. So the final stage in completing our thematic screen is ranking all the stocks in our chosen subsector by overall technology leadership. So this screen that's coming up on your screen now ranks our universe of 21 internet stocks on the basis of whether they're technology leaders or laggards in the 10 most important technology cycles for that industry. As you can see, big data is one of these themes, but other relevant themes include mobile, cloud, social media, etc. Now behind each of these themes lies a detailed research report. There's a few research reports there, which identify the winners and losers from each of these themes. A score of 1 denotes a technology laggard, and a score of 5 denotes a technology leader. Each technology theme is weighed in accordance with the impact it's likely to have on earnings prospects for that industry. And then all 10 technology leadership scores are then consolidated to produce an overall thematic ranking. The tricky bit is combining all these themes, because most themes are interlinked and many themes can conflict with one another. So our resulting rankings are subjective, and they rely heavily on the detailed research we've done before. But what this screen shows you is that Google, Alibaba, and Apple are the thematic leaders in this sector. Yahoo, by contrast, is at the bottom. It leads in very few technology cycles. Now this screen shows that Apple ranks 3rd out of its 21 peers in global technology leadership in this sector. It shows that Apple's not only a leader in mobile, but also in 7 out of 10 of the cycles that matter most in this sector. And this gives it higher potential for future earnings upside. Our thematic approach to looking at Apple has performed consistently over the last few years. We correctly identified a buying opportunity in February 2013 after a price crash, and again another buying opportunity in September 2014 when Apple announced a number of new products which granted it leadership in a number of new investment themes. The important thing to note here is that these recommendations are not based by second-guessing supply chain issues or making decisions based on rumored product launches, or even by trying to predict quarterly earnings. What we're trying to do here is help investors understand whether Apple has a leading presence in the themes that it should be in. And finally, we combine all 3 of our screens together to get our stock picks. So we've seen how the thematic screen works. First, we identify the top 10 themes impacting a TMT sector. Let's say the internet sector. Then we research that theme and we identify the 3 or 4 winners and losers. Then we rank each company in this sector to signify whether they're technology leaders or laggards based on our research. Then we weight the 10 themes by their likely impact on sector earnings. And then our thematic screen gives us a ranking of the overall technology leadership in the themes that matter. So in our example here, Apple ranks 3rd in overall technology leadership in the internet sector. And then we have 2 other screens, the valuation screen and the risk screen. The valuation screen ranks Apple about 4th, so it's relatively cheap within its sector. And the risk screen ranks Apple against its global peers by our assessment of 4 investor risks: political risk, corporate governance risk, accounting risk, and technology risk. And it's notable that whilst Apple is near the top of this risk scale, in other words, it's low risk, Alibaba is right at the bottom. And this risk screen came in handy just before the Alibaba IPO, when investors wanted to know how to play Alibaba. So we published a report just 2 weeks before the Alibaba IPO, and we said 3 things. We said on a valuation level, Alibaba is pretty cheap. It's in the top 3rd at IPO price on the valuation screen. Thematically, Alibaba was off the clock. It was extremely strong. It was a market leader or an established player in 8 out of the 10 technology cycles that mattered for its industry. But the risk screen was flashing red. And Alibaba, as you might be able to see from here, is bottom of the risk screen. So what did we advise our clients to do? Well, we said that they should enter the stock at the IPO price because it was cheap and it was thematically strong, but they should be prepared to exit in the event that some of these risks materialize. And we identified 20 such share price triggers on which to exit the stock. One of those triggers materialized in January this year, and that was when it was announced that Alibaba was under investigation by the Chinese state regulator, the SAIC, for selling counterfeit goods. And the stock fell 10% in the aftermath. So we've talked about our approach. Does it actually work? Well, our stock ratings are tracked by Bloomberg, and in 2014, CM Research outperformed Bloomberg's benchmark analyst ratings index by 4%. And this index, in this index, Bloomberg measures how good analysts are at predicting stock price movements on a 12-month investment horizon. But more importantly than just looking at what some third-party company validates our approach, let's look at some actual examples. So, example 1. A few years ago, we looked at, or in 2011, we looked at the smartphone industry as an investment theme. And our key finding was that the importance of software within the mobile phone value chain was rising fast. So one of the biggest hardware makers at that time, HTC, which was behind in software, we rated as a sell as this theme was progressing. And we picked Google, which developed the Android software on which HTC depended, as a buy. What happened in the 2 years that followed? HTC shares fell 75% because it was on the wrong end of this theme. Google shares rose 62% because it was on the right end of this theme. During that period, the S&P 500 rose by 20%. Next theme, cybersecurity. So we've touched on cybersecurity before. In May 2013, we looked at cybersecurity as an investment theme in its own right, independent of big data. We interviewed executives in the insurance industry because often it's the insurance industry that quantifies new risks before anybody else does. And we concluded that demand for cybersecurity services would rise, and that despite some of the highest valuations in the sector, we said that the cybersecurity industry was one of the most undervalued sectors within global TMT. We predicted that a number of cybersecurity stocks would rally in the areas that I mentioned: unified threat management, the zero-day attack scenario. And those were Checkpoint, Verint Systems, Palo Alto, and Fortinet. And some of the other stocks in that area, SourceFire and WebSense, got taken over at significant premiums. We now think the cybersecurity sector is expensive, but we still like the leader in unified threat management, which is FireEye. If you look at its valuation, it's trading on ridiculous multiples, but we think it could go still higher because this theme has much way to run. Big data. We looked at big data in 2014, and we mentioned to you earlier that the areas we liked were analytics and cybersecurity, but there were also areas we didn't like. And big data speeds up the transition to the cloud. So the big losers in the big data about investment theme, as far as we were concerned a year ago, were IBM, Oracle, and SAP. And in that period, IBM, in the year after that report, IBM and SAP have underperformed quite significantly, but we were wrong on Oracle. And finally, Apple. You can't look at tech without looking at Apple. So in February 2013, we correctly identified a buying opportunity for Apple after a price crash. Then we reiterated our buy rating in September 2014 after Apple announced a number of new products, Apple Pay, Apple Watch, and the iPhone 6, which granted it leadership in a whole bunch of new investment themes. And again, as you can see, the stock's performed quite well since then. 85% gain since our first recommendation, 26% gain since our second. The recommendations were based on that thematic screen that we saw earlier, where Apple became a leader in more technology cycles than it was in before. So just to sum up our approach and our research philosophy. Our research is independent, it's thematic, and it focuses on global TMT stocks. We have a view of the top 500 global TMT stocks. And we look at the world very differently to the siloed view of analysts in traditional brokerages, who perhaps cover 5 or 6 stocks in a specific sector in a specific region. We look at the world thematically rather than bottom-up, because otherwise you miss the big trends. We look at technology globally rather than regionally, because you can't understand Alibaba simply by sitting in China. You need to understand what Google, Amazon, and Facebook are doing elsewhere around the world. And we look at tech, media, and telecom stocks rather than just technology stocks, because technological disruptions have been spilling over to telecoms and media for a good few years now. You can't understand the film industry until you understand what video streaming technology can do. Soon our thematic approach will be applicable to other sectors like healthcare, automobiles, defense, and aerospace, as they too become more technology dependent. And finally, I'm just going to leave you with our current top 5 buys and top 5 sells. We can discuss them later in the break. And I'm going to leave you with some of our reports here if you'd like to pick them up afterwards. And Elgin will be your main contact man if you have any questions for us later. But both Elgin and myself will be at the drinks at 5:30 onwards. Thank you very much. Are there any questions? Yes?
Could you maybe talk about another time when you've made the wrong call, and
sure.
Maybe talk a little bit about what went wrong?
Sure. So one topic that's quite in vogue now is net neutrality. I'm not sure if everybody knows what net neutrality is, but net neutrality refers to a regulatory principle for the internet. It simply says that a telecom network should be neutral to all internet traffic. Now, 4 years ago, we said net neutrality would collapse as a regulatory regime because we thought it was economically unsustainable. It was economically unsustainable for a broad number of reasons, but in summary, because the telecom sector was subsidizing the internet sector. There was a good reason for doing that. The internet sector had to innovate, had to be open, and had to grow. And that's why net neutrality came about. But now, we're witnessing a huge debate. So we've been wrong for 3 years on that. But a couple of months ago, the FCC chairman, Tom Wheeler in America, pretty much reversed net neutrality, and he almost allowed fast lane internet access. In other words, he allowed operators like Comcast to charge internet companies like Netflix for using their network. Until recently, that was illegal because it breaks the net neutrality rules. Now, of course, we found a couple of days earlier that they reversed that rule under pressure from President Obama. So our view now, so we've been wrong for 4 years, but our view today is that the FCC has made a decision that's simply going to be reversed a couple of years down the road. So when the Republicans get in a couple of years, My view is that net neutrality will be relaxed or scrapped altogether. So that's an area where we got it wrong for 4 years, but what we did was every 6 months when new evidence came up, we updated our minds. We almost got it right a few months ago when Tom Whelan did a U-turn on net neutrality, but he's done another U-turn under pressure from the US public.
So on your kinetic screen,
Yes.
do you apply certain weights to the themes?
Yes. Yes.
Are those weights the same for all of the companies?
Yes.
Okay, so
Yes.
even though certain themes may be more of a key driver for certain companies than others,
Yes.
you apply the same weight for all?
Yeah, we apply the same weightings for every company in a specific sector. But a company like Apple and Google could be in a number of sectors. So Apple could be in the internet sector, it could be in the hardware sector as well. So in those cases, they have different weightings. Any more questions? Thank you very much.
Thank you. Any questions or feel free to comments on that?
Yeah, so he's planning to stay here till about 4:30. Yeah.
However, that hasn't been an impact on stock performance, certainly not over the last 3 years. The stocks performed extremely well through 2014 and 2013 and 2012. And the reason for that is simply the dynamic of semis is changing. It's moving from being a growth sector to being a sector which is generating a ton of cash. And as that growth has slowed and new set of investors come into semis with a more value orientation, the re-rating, the de-rating and then re-rating of the sector has been quite notable. Semis now, as it stands, is hitting record EBIT margins and generating record free cash flow. What is clear though is that the growth drivers continue to slide away, And I think that's certainly the case for 2015 and indeed as we look into 2016. There are a few exceptions to this clearly. Servers, smartphones, there are pockets of strength in enterprise SSD, but overall, we think there is little room left for further margin expansion as growth has been taken out of the top line. These businesses have consolidated. We've seen significant consolidation across the sector, whether from DRAM, NAND, through analog, and as that consolidation has happened, businesses have rationalised. Management teams running the businesses have moved from looking for market share to optimising their business models, and we've seen a strong surge upwards in margins to reflect that optimisation of the business model. So if we then look through to the key areas of growth in 2015, I thought I'd focus on just a couple of areas there. The first is, if we look at, for example, what's been happening there, talking about the consolidation of the sector, that has been partially true for now. We think there's more consolidation to come through, following in the footsteps of DRAM, where we've seen 10 players consolidate to 3. We've seen margins go from 10 years of pretty significant EBIT margin losses to 40% EBIT margin over the last 2.5 years, as that consolidation process has happened and more rationalised pricing structure has followed. For NAND, we are still in that rationalisation process, but if you look at the growth drivers for NAND flash, particularly enterprise SSD, is starting to make an impact, and if we're getting to a price point, which I think we are, where SSD, which is solid-state drives, starts to take over from hard disk drives, which have traditionally been used for mainstream storage, particularly in server centers, then we start to see an inflection point in bit growth demand for the NAND industry and for the NAND players. That, however, does not go hand in hand with any kind of pricing rationality. In fact, what we're seeing as a backdrop to what's going on in NAND is that Samsung, who have 40–50% of the NAND market, 40–50% of the NAND market currently, is starting a pricing charge in order to suck margins out of competitors, and they can do that because they're leading from a process perspective. They have the lowest cost chips in the industry. They're starting to suck margins out of their peers and drive the price point in NAND down to a point where the hard disk drive and SSD switch inside mission-critical functions inside big cloud computing players starts to look attractive. So whilst semis overall is starting to slow, there are clearly still pockets of growth. Smartphones in the emerging markets, another good example. The issue with that is that we are seeing fewer and fewer drivers of leading edge demand. And leading edge demand is effectively what has driven the industry through the last 20 years. And a good example of that has been the growth of the foundry players led by TSMC. And TSMC has dominated leading edge foundry for the last decade. What is happening now is that we are starting to see a significant inflection point within the foundry space from two different perspectives. One, competitive. We're starting to see Samsung LSI, which is a foundry on Samsung Electronics, enter more aggressively the foundry space at the leading edge, and it's able to do that because it's been generating A, such high returns in its memory business, and B, because NAND and DRAM is largely caught up with the logic process roadmap for the leading edge logic chips, i.e. chips that are producing leading edge processors, chips that go into your smartphones. And as this competitive drive from Samsung is unfolding, and that's unfolded insofar as they've taken market share at Apple. They're somewhere in the region of $1 to $2 billion of sales this year from Apple. They've won market share at MediaTek, and to put that in context, Apple, MediaTek, and Qualcomm are significantly the largest buyers of foundry capacity globally. As that competitive dynamic starts to unfold, the high margins that TSMC has seen, for example, over the last decade, particularly over the last 5 years, it's dominated the leading edge. As that starts to come up under fire, we think both margin pressure unfolds inside TSMC, and they will be forced, as part of that dynamic, to become more aggressive in pushing forward their own semi-process roadmap. And we've seen that recently. They've taken a very aggressive stance, moving to 10 nanometers ahead of the rest of the industry, ahead of Samsung, and indeed potentially ahead of Intel. That comes at a cost. So there's a double whammy there. They get pressured in the capacity where they're making their margins currently, and they're being forced to be more aggressive into the next process step, and being more aggressive into what is becoming a more and more complex semiconductor roadmap. Is a highly expensive business. Fabs have gone from $500 million 10 years ago to anywhere between $6 and $8 billion today to set up a leading edge fab. So capital intensity increasing, and the cost per wafer is increasing, which then has to get passed through either ultimately to the OEMs or to the end consumers. However, from a TSMC perspective, it's margin pressure. And so, that obviously translates through to our negative view on TSMC. The second part of the equation on this battle at the leading edge, which is playing out in the foundry space and is evident with what we think will happen to Intel returns over the next few years, is that the semiconductor roadmap, which has been the key driver for cost down within semis and within broader hardware globally, is now coming under sustained pressure. And that's largely as a result of the ending, or at least the significant slowdown of the Moore's Law equation, which has been driven by lithography. Lithography has been the key process at the heart of semiconductors for the last 30 years. For the last 10 years, it's been driven by a process called 193 nanometer lithography, which has been a boon to the industry. It's extremely well understood technology, which has been pushed far beyond what had been thought historically possible, largely because the saving technology, which is EV, has been very late, almost a decade late in its implementation. So that's meant the industry has run with a cash cow process over the last 6-7 years, which again has aided margins and has boosted returns all through the chain. This process is now ending. We're now at the end of what 193 litho can do. EV is still late, and what's that? That is effectively translated into far higher costs to bring on 1,000 wafer starts a month for foundries and indeed for the industry than had been thought likely even 5 years ago. And so as we start to move down to these leading edge process nodes, 16, 14, and then 10 nanometers, we're seeing implications both for foundry players, the semi-cap guys, the equipment providers, insofar as there are only a few players out there now that can afford to do this transition. It's effectively Samsung, Intel, and TSMC. Everyone else is playing catch up. The process technologies involved are extremely complex. They always have been, but we're now pushing the envelope of basic physics. And what that means is that the background is very concentrated at the leading edge, and those players that no longer afford to play there, which is the rest of the industry outside of the top three, are effectively moving their capital back down the line to slightly lagging edge capacity, which means that, so for example, we've seen entry into the foundry space of 28 nanometers by some Chinese players, SMIC leading that. And what that means is that we're seeing a step up in capital intensity at the leading edge and more pressure on margins at what historically been the cash cow from the leading edge, namely the lagging edge process nodes. And this is going to feed through to semi-cap equipment. Semi-cap equipment has effectively been benefiting from this step up in competition that we've seen in the foundry space and the speeding up of the node transition that had been enabled by very well understood process technology over the last decade. That is now ending. And so the semi-cap equipment players led by ASML, who has been instrumental in not delivering EUV for the last 6 years, and we think we'll still have issues around delivering what is a key technology for the semi industry. We think that's delayed at least another 5 years. The result of that will be a significant slowdown in the rate of transition. the cost economics of semis starts to slow, margin pressure builds because we're not seeing the movement through the leading edge nodes on an 18-month to 2-year roadmap that's historically driven the industry. And we see, you know, a raft of what have been very profitable, relatively high growth, very highly cash generative businesses like TSMC, to an extent like SML, Intel included in that, starting to see significant pressure over the next couple of years. The disruptor in all this, both on the memory side and indeed on the logic side, is Samsung, who benefited from having class-leading process technology, who have consolidated the DRAM sector and have used that cash cow in DRAM 40% EBIT margins to generate further competitive pressure into NAND and to fund their logic ambitions, are now seeing, you know, the result of this investment process over the last 3 years in strategy start to come to fruition as they take share off TSMC and they start to take process leadership in the overall semis industry. All of that results in what we think is you know, class-leading technology within semis, which builds into a Apple challenging franchise on the smartphone side and indeed, you know, within the wider digital consumer space, because they essentially have class-leading chips inside into which they can build class-leading hardware instead of selling it externally, which has been the case historically. So, you know, within all of this, there's clearly been an M&A theme running through the last 5 years. We think that in part continues. We think a good example of that would be SMIC, which is a Chinese foundry player. They have now transitioned through to 28 nanometer, which is a cash cow for the industry. They have to take far lower margins than is seen at UMC or TSMC, for example, in order to gain market share. The competitive element of Samsung LSI and foundry at the leading edge is exacerbated by SMIC at the lagging edge. So, you know, all of this comes together into a change, you know, what is a quite significantly changed landscape over the next 2 to 3 years within semis than what we've seen over the last decade. And that also throws up, you know, some interesting investment opportunities. For us, it's you know, negative or short. The traditional foundry players, we think the fabless players, particularly the new fabless players like MediaTek, have an excellent opportunity to leverage up you know, their competitive pressure and their buying power effectively into the foundry space as new players, whether it's SMIC at 28 or Samsung LSI at 40 nanometers, kind of looking for share. We think that's going to be good for guys like Apple and Qualcomm, who are already significant buyers into the foundry space, and it's going to be bad for the equipment players as the whole capital intensity drive within semis over the last decade starts to slow down as a necessity of the increasing complexity of the semis roadmap. So I think that's just a quick view from us on how we see the landscape in semis and how the inflection point, which is underway, starts to throw us some interesting investment opportunities. Thank you very much. So, happy to take questions, or we can do that afterwards.
Can you just remind us what valuations are?
Yeah, so valuations for the industry overall, you know, are at close to record peaks. You know, Xing out the crazy 98 to 02 period, we're at record deep for, you know, well, having pick multiple EV, TV sales, USC, any pretty much any multiple you can pick, and that's just a reflection of record EV margins and high cash generation, and indeed a dividend flow from these businesses, which, you know, would have been inconceivable a decade ago when growth was the all-defining metric for both investors and management teams.
We'll do the healthcare panel.
During this panel, we're going to talk a little bit about competitive advantages within healthcare, major trends impacting healthcare, and the valuation outlook for stocks within the space. My name is Damian Conover. I am the Director of Healthcare Research at Morningstar, and I'm joined by two experts in the field, and I'm going to pass it over to them for brief introductions, both themselves and their affiliations. Lisa Berger.
Thank you very much. You can always tell the afternoon session when the panel is almost as large as the audience, so thank you for hanging on in there. So my name is Lisa Ruckert. I'm the editor of PP Vantage. We're an online news service. We are part of a much wider group called Evaluate, who provide consensus forecasts on the healthcare industry. And if you get a chance to have a look, they're very good. I'll pass it to Christian.
So, Christian Benny, Associate Director on the healthcare team at Edison Investment Research. Edison as a whole, for those who are familiar, we have over 400 retained research clients across multiple sectors. Healthcare is the biggest franchise within Edison, currently around 100 research clients covering multiple disciplines within healthcare and currently with a team of 12 analysts.
All right, super. And with that, we're going to kick it off with a short presentation and then go into a panel discussion. So the presentation, again, is on structural competitive advantages in healthcare. At Morningstar, we spend a lot of time on whether or not we think a firm has a structural advantage. And if it does, we assign it an economic moat. Within healthcare, there's a lot of economic moats relative to a lot of other sectors. And we'll talk about different sources of economic moats going forward, but the basic premise is capitalism works. And if you're getting excess returns, it's going to bring in more competitors until the economic profits are washed away. But sometimes there's structural advantages that are in place that enable firms to have these excess returns for a long period of time. Again, healthcare, even though from the size of the other markets here that also have strong economic moats, if you look at the market cap weighted, healthcare is one of the moatiest sectors. A lot of that has to do with intellectual property, and we'll talk about that more as we go forward. But the key sources here are 5. We talk about cost advantage, switching cost, intangible assets, efficient scale, and the one that, the cost advantage one, as I already mentioned, doesn't come up as much in healthcare, but the network effect comes up virtually none in healthcare, but we will talk a little bit more about that as we go through this. I'm going to take time on each one briefly, but spend the most amount of time on intangible assets. Intangible assets really has to do with patents, but it can also do with brand power. But it's got to be a brand that people are willing to pay for. In healthcare, we see a lot of competitive advantages with patent protection. We do see some brand power with consumer products and some other smaller niches, but really brand power is what's going to be driving the economic returns for a lot of the big pharma, the big biotech, even some of the technology within medical devices. Within this, this source, I think a really good example that's listed up here is Roche. Roche is a firm where enormous amounts of products protected by patents. As these patents begin to expire, they're developing the next generation of products. Firms that only have 1 or 2 products, we don't really consider them as having an economic moat because they can't offset the patent losses as effectively as a big pharmaceutical firm. The next one is switching costs. Switching costs don't come up as much in healthcare, but I think it's a powerful one if it does come up. We like to use the orthopedic names as a good example here. Orthopedic names like a Stryker, a surgeon gets trained on a hip or knee from Stryker. It takes them over a month to learn a different product, even if it's the hip or knee from DePuy, just because the system's that much different. A lot of lost economics. So that's something where physicians, even though the hospital may demand you to do a switch, it'll be too hard for the physicians, they'll fight back, it'll be less likely to switch the product. Network effect. Network effect comes up occasionally in healthcare. The classic examples in network effect really happen more in the financial sector. We tend to use the example of MasterCard. As more folks use MasterCard, more merchants want to accept MasterCard. As more merchants accept MasterCard, more consumers want to use MasterCard. So with each node, as more and more players come into the system, the more and more powerful that network effect happens. Our example in healthcare is Intuitive Surgical. As physicians use more and more intuitive surgical products, that builds awareness by patients. Patients demand more and more of the product. Cost advantage doesn't come up quite as much in healthcare, but this is one where if you can bring an economy of scale to a particular area, you can have a lot of power. Novo Nordisk is our example here of a wide economic moat. This is one where they can manufacture insulin at a very cost-effective rate. I'd argue one of the main reasons why we're not seeing massive amounts of generic competition in insulin is not because of the patents, but it's because of the manufacturing complexity. Novo, Sanofi, Eli Lilly dominate the space because of this manufacturing scale. Last one, efficient scale. Efficient scale tends to be in a market where if too many folks come into a particular category, all the economics get washed away. You know, a couple examples here, rare orphan diseases, not usually bringing in a lot of competition. When more folks come into the market, there's just not enough economics there to really reward all the players. Spend a little bit of time on this slide. This is looks like it's pretty hard to read, so let me walk through some of the key points here. We're talking about trends in the pharmaceutical industry. And the real key here is patent protection and intellectual property. That's a trend that we think is stable. There hasn't been much change to patent law for decades. But what's important to think about here is how strong the research and development pipeline is within this context. And that's an area where we're going to talk a little bit with our panel about has R&D productivity improved. Our viewpoint is it's beginning to stabilize, but the R&D productivity is nowhere where it once was over a decade and a half ago. The next point here is the distribution. Distribution used to be a very powerful trend in pharmaceutical research where you just bring armies of salespeople to get your products out to the market. We're seeing that trend go negative, and I don't see that abating anytime soon. The one geography where sales and distribution is really critical is still emerging markets, and in time that will probably wash away. The last point here is brand names. Again, in the intellectual property space here, a lot of these firms, a lot of the pharmaceutical firms have over-the-counter markets, and if they have that brand power, that helps them not only get the superior pricing, but also sometimes work their way into areas where they're just at the beginning part of the spending curve in healthcare, so into emerging markets. If you're able to bring the branded products, the vaccines, the diabetes, drugs, that usually positions you well to continually move into emerging markets. As far as the breadth of the product offering, that's where we see the moats really come into play. Meaning, the more products that you have, the more ability you have to bring the next generation of products out there. So one product company is a company we probably wouldn't see having a strong competitive advantage. So I just want to leave you with a couple slides before opening it up to the panel. This is the healthcare focus list at Morningstar, and it's stocks that are rebalanced basically monthly, and it's where we're looking at the cheapest healthcare stocks with wide or narrow economic moats. And you can't see it extremely well, but the top line is our performance. We're outperforming our index by close to double since inception in 2008. And the very bottom line is the market. The middle line in there is our benchmark, the healthcare ETF. The key stocks we are looking at right now that are on our list, a couple of them that I'd highlight. The one that I'd maybe leave you with the most, that we think is most undervalued, is immuno-oncology company Merck, which also has a lot of other products, but the main reason we like it is immuno-oncology. You know, one of the questions I'm going to pose to the panel a little bit later is what's the most underappreciated thing in healthcare? We think immuno-oncology is significantly underappreciated. Bristol Myers, Merck, Roche, AstraZeneca are the four companies that probably have the most exposure to PD-1 and PD-L1, the immuno-oncology assets. This is something where there's a lot of expectations for these products. We think the potential is even greater than what's out there right now. Immuno-oncology, I think, is going to be the next piece of strengthening the moats for large-cap pharmaceutical firms. A couple of the other names up there that we think are significant and appreciated, Baxter, Actavis. But one thing I'd point out here is if you aggregate our price to fair values, we're pretty close to 1 for our most undervalued names. Going back to what my colleague Alex Morozov was saying, we're seeing healthcare as getting to slightly overvalued territory. So you have to be very careful. And if you are looking into healthcare, you really want to be looking at areas of unmet medical need because valuations have gotten pretty high. 2 last slides before we shift over. This is our mid-cap performance since 2010. Really broke away from the index just a couple of years ago. This area is even harder, in our view, to find undervalued names. It's a challenging area. A lot of valuations have increased significantly. Elekta is one of our top recommendations in this space. This is radiotherapy, strong economic moat, wide, in our view, largely due to the high switching costs, the technology know-how. Once you understand these systems, very hard to switch out of it. You really have 2 key players, Elekta and Varian. Elekta very well positioned. So with that, I want to turn it over to some discussion with the panel, and I think I'll move to the table for the discussions, and we'll open it up for questions after a couple of key points. So, Lisa, one of the things that I think is on every investor mind, and we get the question all the time, is pricing pressure. You know, pricing pressure, particularly in the U.S. But we're seeing pricing pressure from a lot of governments. How significant is this headwind, and do you think this is a long-term or a near-term headwind?
I think it's something that's on everybody's mind. It's something that you hear about all the time. And I think one of the ways I think it was demonstrated quite definitely last year was the fact that when people started talking about the price of Sovaldi, are you all familiar with Sovaldi, the most expensive drugs on the market at the moment? I think it works out about £1,000 per pill. So I'm sure there might be black market, but anyway, we shall see. But one of the things happened there was when there was some sort of like active discussions even from governments about the prices about it, the actual NASDAQ itself wobbled, and there might be an indication of the fact that the government's trying to be about the pricing. So we've also seen a couple of other healthcare stocks, such as Sanofi and Glaxo, suffered last year from payers actually pushing back on pricing. And so yeah, I think it is going to be more and more significant because healthcare budgets are finite and drug costs are going up.
Yeah, and Christian, one of the things we've seen, particularly in the U.S., is if there's too much pushback on controlling costs, so the HMOs of the 1990s, there was major pushback. Are we getting to that point of pushback by governments forcing folks too much into a certain drug just to try to control costs? Are we at a tipping point there, or is pricing pressure still going to keep coming?
I think it's still be a factor. I mean, ultimately, the challenge is on the pharmaceutical and biotech companies to, when they develop their products, to very much go for treatments and effects and unmet medical needs that are really changing people's lives. And when you talk about cancer, you need to get into much more dramatic improvements of overall survival, not just sort of to be flippant, not to be too flippant about it, sort of fairly marginal increases in the life. So if you can tie in fundamental outcomes, then you have a much stronger argument. So, for example, with the Sovaldi thing, you saw actually the flip side was, it's a very expensive drug, but these are patients with potentially progressing on to much more serious stages of hepatitis and liver disease, and ultimately potentially liver transplants, and the cost of that much more dramatic than the earlier intervention. That's ultimately where, again, we see a lot more. That's where the winners are going to be as well, isn't it? Ultimately, it's about identifying patients and intubating early.
Yes, the point. When we look at valuation of the space right now, it's at a very high level. A lot of that's having to do with R&D productivity. R&D productivity, in our view, is improving, stabilizing. But Lisa, where do you see R&D productivity? Where do you think it's been? Where do you think it is now? And where do you think it's going?
It's an interesting one, actually. I think the uptick in R&D productivity is one of the reasons why the sector did so well last year. I mean, if we'd done the conference, let's say, in the middle of last year, and titled it "How to Make Money Without Really Trying," there'd be a lot more of you in the room. But I think one of the things was because we've seen an uptick in R&D productivity that has come from various reasons. The FDA, I think, has become a lot more collaborative with biotechs and pharma companies who's working with them to actually sort of make sure that drugs do actually get through the regulatory process. We also saw the introduction of the breakthrough therapy designation, which I think played a big part in introducing some very very innovative drugs for unmet medical needs that obviously, because there are unmet medical needs, companies would charge more for. So that kind of also helps stimulate the sector as well. So I think we are going to carry on seeing gains in productivity, and also we're also judging it against 2012, which was the last year of patent cliff, where there was very little productivity, and so companies actually did a lot of M&A to buy in productivity. So I think we're going to carry on seeing an uptick because of what's happening with the FDA and its willingness to work with companies. As to whether or not we're going to see a record number of approvals as well last year, who knows? But I do think we're going to carry on getting more and more drugs through the pipeline through the regulatory process.
So maybe a little bit more accommodated FDA, helping to lead to some productivity improvements. Chris, anything to add to kind of the shifting R&D productivity? I think most of us can agree that productivity is better. Anything else driving it in your view?
Yeah, I mean, one thing to say is obviously the cost of development continues to rise. I mean, you have to, the extent of the clinical programs are still significant. But yes, what you are seeing, I think fundamentally it's a better understanding of biology and a better understanding of developing new technologies, new ways of approaching these diseases that will ultimately drive, improve the actual outcomes. And again, going back to sort of early intervention diseases, it's about being able to identify much earlier in the overall R&D process what products are going to succeed, and therefore what's your early stage models predicting future success that are key. And some of the companies, particularly that are working around the models and the genomics and all those sort of things, which should be key.
Yeah, no, I think that's a good point. One thing both Lisa and Chris mentioned that I think is important to reiterate is strategically going after areas of unmet medical need, and that is improving the odds of drug approval and stronger pricing power. I think that's a big strategic shift. If you look back at the last 15 years, a lot of the pharmaceutical firms 15 years ago were really going after just follow-on products, me-too products that the FDA, if they saw any sort of side effect, they would reject it. The pricing that the pharmaceutical firm could get wasn't that strong. So the productivity has been partly the FDA, partly looking at kind of cost-benefit analysis, but also strategically the pharmaceutical firms going after areas of unmet medical need. Hence, we're looking at, I think, a multiple that's the highest that we've seen in the big pharma space for close to 15 years. The stocks are trading close to 19 times estimates. Now that's higher than the average over the last 15 years, which has been closer to about 15. You have to include the 90s to be able to get to a multiple that's in that range. Now, I don't think that valuations have gotten excessive, but we are pushing into that excessive area unless R&D productivity can improve even more.
Yeah, I think it's, are valuations excessive? That's a big question. I mean, I've been calling the top of the market for the last 2 years, so what do I know? But we are getting to the point where I think we're getting definite, if people say it's not, there's not a bubble. We sort of got bits about people saying it's a bit frothy, but the definite areas where I think there are bubbles are forming. Some of the CAR-T therapies, I think it's had a little bit of that kind of climb back. And also some of the immunotherapy companies, like companies like Kite and Juno. These companies have got drugs that have been perhaps tested in actually less people that are in this room, but also have valuations of, I think, respectively, sort of just hovering around the $3 billion mark. And that I find mind-boggling.
The glass is definitely half full. When we're out talking with folks, people are asking about phase 1, phase 2 products. 3-4 years ago, they didn't even want to talk about phase 3. What are your thoughts on the sentiment right now?
Yeah, I mean, it's shown just that Edison, typically we take quite a fundamental approach to our valuation, and typically are fairly rigid around building up the present value of any particular product and building, and a key part of that ultimately is the timelines to market, the probability of success. Now, when you talk about some of these companies in immuno-oncology, which are at $3, $4, $5 billion, any kind of standard NPV model is not going to get anywhere close to those kind of valuations unless you sort of reverse engineer it to work out what the sort of peak sales that would have to support the current value. And ultimately, okay, maybe 1 or 2 of these companies they won't all win. And so that does come back to the pricing round. If you are let's be clear about some of the technologies that these companies are developing. They are, now, even in cancer, certain subpatients of cancer, particularly blood cancers, we are seeing some genuine cures in these areas, which is pretty revolutionary. It's a long way, it's a massive shift on from where we are today in treating some of these cancers.
We're still not treating solid tumours, which is the majority of cancers. I mean, they still have to get past that kind of stuff. It works a lot in blood cancers, but I think where people want the real kind of revolution innovations is solid cancers, the lung cancers, the pancreatic cancers, the ovarian cancers, where there are very few treatment options and patients, lives are very, very, if once you're diagnosed, likely being alive with those three after 2 to 3 years is very, very slim. And I think that's where perhaps companies need to be looking at. I think that's maybe where the big valuation of the companies will be cracked out. And we were talking earlier about the other areas of unmet medical need which still haven't been addressed, which is obviously the dementias and the Alzheimer's. And that is another area where we could see kind of sort of let's Gilead emerging from. Where cracks those two is pretty much they are going to be huge.
So just to make sure we're setting the context right, we're talking about a lot of different therapies. The one that I think we as a panel agree on that is getting stretched in evaluation is the CAR T therapies. This is Kite, Juno, Novartis has a leading product there. The area where I think we agree that there's a lot of opportunity, we may disagree about the full potential, is in a different part of immuno-oncology. It's called PD-1 and PD-L1. I'm a very big believer that the opportunity is significantly large. I think my colleagues, let them speak for those, think it's going to be large, but potentially already in the stocks. Am I characterizing the viewpoints correctly?
Yeah, I mean, I think some of the valuations and